Hello, everyone, both in person and online. I appreciate you guys taking the time to come today. So, the title of this that I named, this was actually Dave Malwini and I coming up with this a few years ago, Keys to Building a Successful and Sellable Startup. But the interesting thing, because the first thing probably any entrepreneur thinks of is product, not so much cash flow and being organized. So I am going to talk about how obviously product is key. However, some of these, what would to many entrepreneurs look like either boring or seriously, this is really important, why it actually is. And I have many years to prove it. So this is what I call my audacious thought. With accurate cash flow forecasts and organized digital files to back up the cash flow, you are probably at least 75% of your way to being prepared to bringing on new capital or to selling the company. Now, I will be full on. I have not done any like detailed studies to come up with the 75%, but after 4+ startups being sold after numerous acquisitions, both on both sides. This is just my anecdotal, but in talking with the entrepreneurs who I helped sell their company, they were like, "Are you sure it's only 75%?" Point being is, regardless of what the exact percent is, it's actually a significant, shockingly to entrepreneurs, it's actually a significant part of the capital acquisition and or selling process. Just a very brief on my background. Allison told you kind of on the education where I am right now, and I alluded to. So right out of college, I started at PPG, a good big company. Came back for grad school, started a company called Respironics. Talk about how times have changed. It was a public company when I started at 36 million in revenue. Times have changed. We didn't have quite all the same requirements needed for and the costs and expenses on a public company. But when I started at Respironics and spent time there, that's kind of where I got the kind of entrepreneurial bug. And after that, I didn't necessarily do it on purpose, but as it turned out, I then only went to companies that were either early stage or maybe middle stage, if you will. But one of the things that I did in all of those cases was I helped grow them and we got to sell. In the process, we obviously did, when I was at both Respironics at a company called Taggart, I think I've lost track, but I'm going to say between 9 and 10 acquisitions and integrations on both sides, meaning we were either I was involved with being acquired and or we were acquiring. And one of the big things that I was then responsible for was the integration. And then after other than those two companies, I had a lot of, smaller startups starting at, the 1 to 2 million, 3 million, kind of growing them, getting to a sale. So it's kind of a more of a traditional looking entrepreneur and startup company. This presentation, I want it to be interactive. And I want you to get something tangible out of it, something that you can take back, that you can think about at your own company, your current company, and any other future companies. So one of the things that, and the reason why I always ask Allison for the board is, I just want to ask both on an in-person and online. You signed up for this, signed up to spend an hour here. Why did you sign up? What were the questions that you were hoping to get answered, or what did you want to learn about, or why did you attend? So what I like to do is I like to kind of write those down once, maybe then as I'm going through the presentation, I can address it. But at a minimum, though, at the very end, kind of look back to see if I've answered all the questions, or if there were some things that maybe didn't naturally come up in this specific presentation, but that I could answer. So kind of think back on why did you sign up? What were you hoping to get out? I just want to kind of jot those down. So anybody?
Yeah, I think running a startup, you're always focused on what's right in front of you, making the next sale, building the next feature on the product, and you're often not thinking about it with the end in mind. So I'm interested to hear about that perspective from someone who's been there, done that. What are the things we should be doing now to be prepared?
Okay. And thank you.
Yeah, I'm an entrepreneur and I just know that my weakness is the financial side. I just get really anxious about it.
Mhm.
But I also recognize how pertinent it is to the success of the company. So I think just further education of strength there.
I'm sure I'm spelling this wrong. I always spell it wrong. Okay. Anyone else?
I would like to know when do I expect the, like having a returns and some profits, because regularly, like the first year, I face losses.
Mm-hmm.
So I would like to understand this dynamics. And when do I like continue and I believe that I can sell it, or I just admit that I need to close it.
Right. Mm-hmm.
Like a lot of alternate ones. So a lot of times when we participate in startup competitions, we're talked to VCs. So you usually ask for ROIs or break-even points, but we haven't started to generate revenue.
Right.
So in this case, I don't really know how I can make accurate predictions of our future user bases.
Okay. Anyone online with any questions?
Yeah, when you're selling medical products, some of these sales cycles can be super long and have uncertain timelines. So,
Yep.
you know, kind of tying into that, you know, thinking about how to forecast out, like really far out uncertainty for revenues.
Good one. Anyone online with any questions, or not questions, but comments as to why you're joining or hope things that you hope to hear about? Okay, well, we'll go ahead and get going. And again, throughout the presentation, please ask questions if things come up. Again, this is for you. So I don't want this me lecturing out. This is hopefully an opportunity for you to learn, ask questions, especially specifically with what you're kind of going through, have gone through, or might go through. So most likely, when the reason why companies come in place, whether they're a for-profit or a nonprofit, obviously there might be a mission. If it's on a nonprofit, it might be a specific idea. But in the end, it comes down to companies want to make money. And when I say make money, again, they might be profitable, but you want to make money so you can continue on and staying in business. Maybe you want to grow the business. Maybe it's a lifestyle company and you just want to make sure you're continuing to help support, your life, your family, and you go on. Maybe you want to grow it. Maybe you want to sell it. But these are all, whatever it is, no company generally wants to have to shut down, but that may also be a potential. But that's not why you started the company. You probably started a company in the hope of making money, in making a lifestyle, in selling it and growing it. So that's kind of the initial. As I talked at the very beginning, the first and foremost, obviously, when you start a company, is you have to have a good product that's solving a solution, solving a problem, answering a question, disrupting, maybe making a product or a process better. Has to do something. or else why would anyone buy it? One of the things you hear about in forecasting, or you probably have heard when you're, coming up with new products, is if you come up with the product, and let's say it's a bottled water industry, and I'm making up numbers, I have no idea. But let's say it's a $10 billion in a year company, or a market. And I come up with the product, you say, oh, well, I should be able to get 5%. That's not how it works. You have to figure out, well, okay, you can get 5%, but how are you getting 5%? Who's coming to you? What's different? Why is it unique? You just don't get to say, oh, it's a big company or big market, I'm going to have part of it. So your focus is on having a good product that's solving a problem, improving a problem, doing something better, more efficiently. That's your initial focus, hands down, period. Then now we came up with this really cool product idea. And probably many of you are starting to deal with this now. Now you have to start thinking, what's the organization behind it? Who are the right people that I need to bring in? What are the right skills? Is it manufacturing? Is it more, I keep looking at my bottle of water here, but, is it, software development? Is it AI development? Is it marketing, et cetera? So now you have a product. Now you have to figure out, how do I put an organization together? Usually the last group that you think about, and it's not necessarily a wrong thing, is the finance person, is the HR person, is kind of any of that back office stuff. Because, let's be honest. And again, I'm a longtime CFO. I've had HR, I've had, COO. I'm a kind of a back office person, if you will. You don't need us in the beginning, or you can get a lot of temp help. You can bring in, my neighbor's kid is studying accounting. They can do some stuff. That's all fine and good. That is not your initial. But at some point, you have to start thinking about the kind of the back office side of it. And the first and foremost is you've got to be organized. Again, you do not have to hire an executive assistant. You don't have to hire someone to be in there keeping yourself and all of your information organized. You have to start this. So when I had one of my entrepreneur companies, he told me when we were going through the acquisition, he looked at me and he said, Kelley, if I ever start another company again, I'm hiring you to walk around carrying a bat and just hit me over the head anytime I don't save anything. Because what happened was we weren't preparing to sell the company. We were actually starting an audit. I just closed in on a bank loan. We were actually just starting to grow and maybe to start doing some acquisitions of our own. Well, an acquirer came up that it was one of those too good to be true type of thing. So we had to get on it. Well, so Steve had started the company maybe like a year and a half or two before I came. Well, when you go through an acquisition, or when you go through any capital acquisition, banks, venture capitals, private equity, the list of questions and documents that they are asking for is quite large. And it is surrounding, and we'll talk about it here in a minute, it is surrounding not just about the product. So you need to start on day one with being organized. And again, you can do this yourself, but these are examples of things that you absolutely positively have to have, because they will be asked. Even if you started a company, say today, and you didn't go through an acquisition 10 years from now, or maybe you're getting a loan in 3 years, and you have some customers or some vendors who you don't even use anymore, or you have some employees that are no longer with you anymore. The reality is, the reason why companies ask for all of this is they want to make sure that you don't have any outstanding liabilities, outstanding or potential problems with, let's say you had you've let go of an employee a year ago. Are they going to sue you? Was there a problem with a vendor or a customer? Your organizational documents, these are the things, and they may be emails. But when you started your company, you created the LLC, or you got yourself a tax ID number. These are all the things that you have to keep. Then you move on to, well, these things you may not have to keep, but they are just one level down, and I would highly suggest that you do. As you go through, and we'll talk a little bit more about, kind of budgets and cash flows. Some of the budgets that you do, quite frankly, might be on something like this. You and your buddies might be sitting around doing this. Then take a picture, keep it. The reason why is when people are looking to acquire you or invest in you, they want to understand, how are you thinking? They want to understand, I think it was you. Yeah, that's what you asked the question about, well, how do I know if should I just shut the company, or am I going to be profitable? When am I going to be profitable? These are going to be the information that's going to help potential customers, but potential buyers look to understand, how do you think? What are some of the progress that you were expecting? What was the way that you were thinking to grow the company? So you're going to have KPI reports. You're going to have, you may have some initial investors, maybe it's family and friends. You may have a little bit of board of directors. You're going to have regular meetings. You're going to send emails out to investors because they're going to want to know updates. You keep everything. And my last is, when in doubt, you just keep it. And again, as I said a couple slides ago, this isn't sexy, but I am telling you, if you do not do this, it is going to be a nightmare when the time comes for you to either sell or to invest. Now, the beauty of this, and these are, again, the whys. Why do we do this? Going back to that my audacious comment, that if you have this stuff in the beginning, the sell price process will be much easier. So a company I'm at now, the company started in 2020. We really didn't hit. So I joined it part-time in 21, became full-time just over a year ago. And that's what, we did a funding round. So I have a Dropbox and I'm just loading stuff in. So the round is over, but I'm continuing to put what those requests in, like the monthly financials, some different information on the revenue. Because when we do have another round and or sell in a couple of years, I do not want to have to go back and recreate everything. So I'm just on a monthly cycle. I just do all of that on a regular basis. The reason why is when you're in finance. So what the things that I do, I do not necessarily add value to the product. And what I mean by that is, when we're selling the company that I work for, no one is buying a company because I'm really good at cash forecasting, or I'm really good at managing my finance and accounting. That's not why they're buying it. They're buying it because of the product. They're buying it because of the market that's been identified. But when I do my job well, and that offer came in at a sell price, I help keep the sell price. Because if you've never tried to sell a company in the past, let me give you a little hint, or a little kind of secret. Let's say they offer you $50 million for your in a term sheet. Well, that term sheet is just a term sheet. Because what's going to happen on day 2, the job of the outside accountants, the outside lawyers, the outside everybody, is to try to help their company, the one buying, drive the price down. And how they drive the price down is by putting and saying, well, they have this risk, or their forecasts aren't that great. They don't really have this backup. They're not able to prove this. So they may still keep the sell price at 50 million, but then they start putting in all of these qualifiers that help to either reduce the sell price, or they push out when you could potentially get that revenue. So maybe it's, well, we'll give you 35 now, but in a year from now, we'll give you that remaining 15. Well, even if you get 50, if most of it's not coming for a year or so, that's basically a discount, correct? So what we're trying to do, everything I'm trying to show you, talk about you today, it is not going to increase the the price of your company. It's going to help keep the price of your company, because the people buying you now know that everything you've told them is true, because you've been able to back it up. And trust me, I have helped keep money for many of my owners and investors, and they've been quite appreciative. And obviously I've had share also in those companies. So I'm appreciative because I got the full value. And this last comment, if you start doing this from day one, it is easy because it's just habit. It's just routine. Now, there are, this, and it does not have to be complicated. I mentioned the word Dropbox. There's obviously Google Drive. You have SharePoint. Quite frankly, one of the big things, since email is such a big thing, create email folders. Have an email folder that says, and I have it in mine. I'll have board of director communications. I'll have monthly financials. I have corporate documents because I get all those by email. Now, eventually you will want to have something and putting it into like a Dropbox or in something outside, just more for, just as a security and for a backup. But all this stuff can be free. This isn't inexpensive. Now, as you grow as a company, there are more opportunities out there. There's things that can be focused on boards. Like I use, there's Board Effects. There's Carta for like a lot of your, the cap tables, etc. But again, things like these do not need to be complicated. So again, I realize that isn't fun and sexy, but you're going to have to trust me. These things are incredibly crucial for you as you go forward. And it just helps you keep peace of mind. Because let's say you're going down the road and you have a dispute with a customer, dispute with a vendor. If you have all the backup documents, it's going to help you if there are any issues with pricing or timing. Now, the other thing is all of those things that I've mentioned, maybe not all of them, but the majority of them basically support either a cash in or a cash out, AKA cash flow. You're going to have vendor documents. You're going to have customer documents. You're going to have documents for your expenses, your rents, your et cetera. By keeping all of that, if there are ever issues, you can address it. But again, when you're selling a company or when you are getting investors or banks involved, they want to understand cash flow and they're going to ask for proof. That's going to support all of your cash flow. Back when I was a student here, we had a professor. He has unfortunately since passed away, Richard Green. He used to have a comment, debt is good. Okay, debt is good, but cash is really good. And when we say cash obviously can come from debt, meaning, convertible debt. Like, for example, we just did our convertible debt round last year, or you could do equity. But regardless, when you are a small company, and I would argue a large company, look at Boeing, you have to have cash. The reason why most companies go out of business is because they run out of cash. Now, you had mentioned before about this isn't your thing. Cash flows do not have to be hard. And I'm going to show you a couple of examples of very, quite frankly, easy cash flow. People get very nervous and anxious about cash flow, but the reality is cash flow is two things: cash in, cash out. That's all it is. Now, what I'm going to show is I'm going to show you a couple examples of a couple different companies that I've worked for. Is one, you may work for a company that it gets paid annually or quarterly, or, it's a long time frame. Those type of firms that, I mean, obviously it's wonderful getting all that cash up front. Don't get me wrong. That's awesome. But then that puts a lot more pressure on you to make sure you use it correctly throughout the whole year. That's when I tend to use these 8 to 13 week rolling cash flows. And I'll show you an example. And the reason why I do that is because you might have, because some companies do monthly payrolls, some will do every other week payrolls. But therefore, if you're only getting paid on an annual basis, the timing of when you get paid versus the timing when you have payrolls or the timing of when you have to pay your taxes or rents, they become very critical. Now, a company I'm at now, we get paid monthly. So it's a little more secure because I know pretty much, within a 2-week time period, I'm getting all my cash in. So that one, I then tend to do a monthly, kind of a 12 to 18 month rolling cash flow. And I'm going to show you examples of both. The other thing about cash, and to this day, and I've been doing this for 15 plus years, I call it Money Monday. Call it whatever you want, pick the day that works best for you. But for me, I always tend to do it Monday. That's kind of my, start for the week. It's like kind of a rolling in, starting for the week. I basically do a cash reconciliation every week. I don't have, it can look different for each, but basically I go through I use QuickBooks right now. I have a spreadsheet that I compare QuickBooks to my bank account. I make sure that all the cash coming in and all the cash coming out, I know it, I understand it, I reconcile it, move on. By doing it every week, there's a security behind that just to make sure that there's no funny business going on with your account. I mean, it's just a cybersecurity. But secondly, you're keeping up on it, because one of the things that I learned, and when I'll show you some of the one spreadsheet, is I assume let's say a customer was supposed to pay you on Tuesday, or it's whatever the 30th of the month. I just assume they do. And then I have payroll coming up. I have other things. Well, don't you need to make sure that you actually got that cash in? So that's kind of when I started doing this. And I will also be honest, I do this on a personal level too. Again, from the security standpoint. But pick a day, you just go in, you just make sure it's there. By doing it on a weekly basis, and for me, by doing that reconciliation, I feel I can sleep better at night, but I also don't get behind. Now, the last, and I think someone else had asked, when you're at a company that, especially when you're in, it was around sales cycle. When you're talking about sales cycle, one of the hardest things, or one of the biggest lessons I had to learn, especially when I was at a little bit of a bigger company and you have salespeople, or not even salespeople, you have development people. It's understanding their view of when a contract is going to be signed. I've had many salespeople say, "Oh, it's a given. Oh my God, they loved it. It's going to be signed." 3 months later, it's still not signed. Then I have someone else who's the opposite. They're very cautious. So one of the things that you really have to understand is your sales cycle. For example, at a couple companies ago, we sold, it was in the AI world in enrollment management to universities. Well, that was like a 9-month sales cycle if we were lucky. Then might have another one that it tends to be a 2 to 3 month. So when I'm looking at these cash flow, and we're going to talk about cash flow, we're going to talk about scenarios, that has to be one of the first things that you really understand about your industry. And if whatever you think of is the initial sales cycle, you might want to double it. So in other words, if you're going out, and because if you're talking to people, and let's say it takes you 2 to 3 months for them to be like, yeah, let's do this. But then you got to add on probably at least another month or two, because if the lawyers get involved, and then if you have IT getting involved. So the reality is, whenever you are starting to do any of this and understanding your sales cycle, you've got to be conservative, and then it's getting paid. So you might say, all right, I met with the customer. Let's say 2 months later, you have a preliminary term signed. Then it goes through the contract. Now you get the lawyer sign. That's 2 months later. Then you do an invoice. Then it's going to be another 1 to 2 months before you paid. So you talk to that customer and you got cash 10 months later. That is not unusual. So that's why laying all of this stuff out and understanding what cash requirements you have is so critical. So I'm going to show you 2 types of cash flows that I've come up with. One, I call it operational. The operational is for those less frequent payments. So again, I was at a customer. It was great. We got paid 100% upfront, which was awesome. But then that money had to last me that entire year. So I have to really, and you'll see it, I lay out, here are all my current customers, and here's when I expect each of those payments to come in. Then here's all my forecasted. So that's where I can do a lot of the scenarios. So up at the top, those are my current customers. then usually I'll do like scenario planning below, like here's future customers. And then you have to look at, do I expect another raise? Do I expect to get a bank loan? So that's all your cash in. Your cash out, payroll, 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 because payroll is going to be your number one. Then you're going to have rents. Then you're going to have, many of you may, to begin with, may be using contractors. You may be using kind of temps or outside software people, not as full-time employees, but those are still going to be monthly payments that you're going to have to pay out. You're going to have credit card expenses because you're traveling, you're, buying equipment, et cetera. So again, it's not hard. It's literally just laying it all out there and putting it in a good old-fashioned spreadsheet and to understand the timing. That is what I use when I have the less frequent. If I'm getting monthly or weekly, so my my payments, my cash flow in is a little bit more consistent, then honestly, I use my budget. EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is a version of cash flow. It's not perfect because you might still have timing, but basically that your EBITDA should be more or less equal to your cash flow. The only difference would be timing. Let's say, for example, people pay a couple weeks late, where they pay in the next month. But that timing, assuming that you don't have meteoric rise, that timing over it should even out your EBITDA. So I use EBITDA coming in as my kind of cash in, and that's my proxy. Go ahead. Yeah. So between EBITDA and what? That's a good question. I do not know what adjusted EBITDA is. I don't know what that's adjusting for. So I don't know. I mean, you have net income, which is the bottom line. EBITDA. Now, sometimes I've heard of EBIT, so EBIT is earnings before interest and taxes. And so it's not including depreciation. So it includes depreciation and amortization. So EBITDA, the reason why that's helping with cash flow is because depreciation and amortization are not cash flow. That's because that's a result of spending capital. So that might be what that is. There's EBIT, and then there's EBITDA. So anything adjusting, I'd probably have to, maybe afterwards you can show me where that is. But my guess is someone has defined that. I just don't know how that's being defined. All right, so now I'm going to share with you, my glasses on, do the escape. All right, so gotta get this bigger. Nope, that's not it. All right, what am I doing? All right, how do I make this bigger? That's not it. Shoot. Okay, sorry, thanks. Yes, the other thing is, if you guys don't know finance people, we all use laptops. We don't do because the Excel and everything. So just a heads up. That's why whenever I get onto Mac stuff, I'm like, yeah, I don't know, understand this one as well. All right, so what this is, so this is what I'm setting this up, and I'll show you kind of as a high level, and we can go through. But basically, what I tried to show here is I have a couple of months that are done, and these are kind of forecasted weeks out, and then it switches down here, like further out into the month. And what I'm trying to show you here is, to start with, I look at my customers. So here's all my customers. Here's when I expect them to pay. So I'm just labeling out. This isn't exciting. Again, I'm emphasizing none of this stuff is hard. None of it's exciting. It just takes work, and you just have to, be, again, kind of that being organized. So that's all my cash in. you may want to look at, if you have churn. So if you're thinking that you might lose some costs, and the churn is obviously, that's not relatable to every customer. That's probably churn is more when it's weekly or monthly, whereas this is on an annual. But I just wanted to show that in case that was, a case for you. Then you have cash out. So cash out, down, why isn't this moving? All right. So then you have cash out. So you have payroll, you have maybe bonuses, you have your tax payments, you have expense reports. Here's all the vendors. So you can see I'm just laying out in my forecast everything that I think of when these expenses are going out. So this is, because what this is also showing any potential investor or customer, this shows your business. You know what you're buying, when you're needed, and how much. So again, you have all this information. It's literally just organizing it and putting it into a spreadsheet. Then down below, usually, so that's when I have my cash in, my cash out. And then when I talked about doing some, scenarios, then I might look at, well, here's some new customers. Let me pull this up. It's harder to see at the bottom. When do you think timing is for new customers? How much? When are they coming? And then that just allows you to do some different scenario planning. But this much detail is needed when you aren't getting paid that much, because the timing of any cash payment is going to be critical so that you can know and when you're making payrolls. Because if you look up here, for example, let me get up to the customers. So you can see, your expenses never die. They're always coming. But what if you have, different, in different months, let's say for example, when I told you that I had a cut, my one company, we sold to universities. Well, we didn't get a lot of new contracts in the summer. Why? Because that's when universities tend to they're on vacation. They're taking their time off. So we did not have a lot of renewals. So for us, my summer, I did not have a lot of cash coming in. So I really had to watch, because by doing this and by doing the other, the big thing is you have to understand what's my cash flow runway and when am I running out of cash. Now, the next one, okay. So now this one is what I'm using right now at my current company. We get paid monthly. So I am much more comfortable that I don't need to do that weekly detail, because I know I have cash coming in. Now, to also be fair, we do a lot of work to make sure everyone pays us on time. I mean, there's always that. So we're constantly communicating. So this one is obviously an easier one. It's less work. You do a budget. So everyone should be doing a budget. And, obviously that would be a whole separate topic. But a budget obviously is, when are we getting paid? What are my costs to do it? But all I need from a cash flow is what's my EBITDA, forecasting for that. And by doing that, then I'm able to kind of see, when is my cash flow? So here I'm showing we're forecasting that we're going to do a fundraise and bring in money. But then what I'm also trying to show here is, oh boy, I'm going cash negative. So what that's telling me is, by doing that far in advance, it's telling me that we need to be doing a fundraise, or I need to be getting a loan. So the reason why you always want to try to have a 12 to 18 to 24 month cash flow is so that you're able to understand when am I going to go negative and how much. The timing might be wrong a little bit, because maybe you can save some, maybe you can reduce some expenses and pull some things in. But generally, that's what you're trying to find out. You can find this out in this one, and you can find it out in the monthly one. But so when you're doing these cash flows, the first thing you want to look at and understand is, how often am I being paid and when? And then you need to match it with, what are my expenses going out? Because you need to understand what your cash flow is so that you know when you might run out of money. Because trust me, that is one thing that banks, your investors do not want. So we talked about this a little bit. The cash flow, you want to initially start with what you know, but then you want to do the scenario planning. And the scenario planning is, how do I need, what new customers do I think I'm going to get? What new products am I going to put in? So therefore, what are the additional costs for that? The reason why you do all those scenario planning, I call it the early, the early warning system. You need to understand your cash flow out of cash flow dates. You need to understand your cash runway. The reason, and you need to also understand, is what levers do you need to pull? So for example, big thing is, let's say in your budget, you have a hiring plan. So I'm going to hire 3 developers here. I'm going to have a couple customer service people, a couple here. Well, if your cash flow is not going to support it, well, what if I'll delay that hiring or I'll push it out? So so by doing all that detail, by putting a budget together, by putting that weekly cash flow together, you understand your levers. You understand, I mean, you have 2 levers, cash in and cash out. But then underneath it is, how do you grow or remove any of those? And the last thing is, and I've had this at a prior company, whenever you get bank loans, if you've never done this yet, they have covenants. And the covenants basically say that you have to meet some minimum KPIs, a great example is, you have to have so much cash in reserve. You have to have so many customers. You have to have, they just put certain requirements in that you have to meet. By doing this, you will give them fair warning. So I had a company, this is a few years ago. I knew I was going to be out of debt covenant. We were going to still be profitable. But we were below their threshold. But I was only going to behold the threshold for 3 months, because I did that forecast. So I warned them in June that in November I was going to be out, but by January I was going to be back in. So normally, if you break a covenant, I call it putting it in you get into the doghouse. And by being put in the doghouse, your interest rates go up. They become less flexible. They won't lend you as much money. But because I was able to forecast out to them and I had that relationship, they didn't put me in the doghouse. They didn't put our company in the doghouse, because I wrote out, we came through it, and they were fine. So by you doing all these forecasts in the cash, because I'm telling you, your banks and your investors, they worry a little bit less about you being profitable in the short term. They worry more about cash, period, in a sense. By doing all of this, and we talked a little bit about this before, it shows that you know your business by getting into this detail. Because what people can't stand is if they say, hey, Kelley, how many employees do you have? I don't know, 20, 30. No, how many? I need to know how many. I need to know what my cash flow is. Hey, when are these contracts up? When are you hiring your next group of people? These are details that your investors expect you to know. And by putting those forecasts together, you have to know it. And by showing it to them. It proves to them that you know. So back in COVID-19, the company I was with prior, I was doing all that weekly cash flow. And, for any of you, who are old enough and you were in the businesses at the time, that was a very scary time from a business standpoint. Well, so we were meeting on a weekly basis with the board, just because, again, our customers were universities, and universities were going through a lot of things, because they were going remote learning, et cetera. So the cash flow, I mean, they needed me to send them daily cash flow information. Well, after about 3 or 4 weeks, they stopped because they were so confident in everything that I was forecasting that it just got back on the monthly. So they were able to worry about more strategic things because they knew we had to handle on this. The other, and I mentioned before about the bankers, when you develop relationship with investors or bankers, you want it to be a relationship. So often people sometimes get a bad rep with their relationship with the bankers. Bankers are people and they want to actually help you. If you set up regular meetings with them, so I try to set up quarterly meetings with my bankers just to do an update. If you share with them both the good and the bad, they want to be partners with you. What they don't want are surprises. Even good surprises, like, which sounds weird, but a good surprise, basically good or bad surprise, says you don't know your company. And when I say a good surprise, you could be like, oh yeah, wow, we just signed this contract for $100 million. I had no idea it was coming. How did you not have it? I know that's a rarity, but shockingly, it does happen. Maybe not 100 million, but a significant. So by doing all of this stuff, by being organized, by being these cash flow, it is telling your outside stakeholders who are investing in your company that you know your company, that they can trust you. They can trust you with their funds. They can trust you with their capital, because guess what? They have jobs and they got people they have to answer to also. So the reason why, so way back when Dave Malwini and I, when we came up with this, and the reason why, we were talking about this kind of product, this idea, was so many entrepreneurs focus on the product, focus on getting the company. What I've shared with you today is not the fun and sexy it is not the reason why you became entrepreneurs. I know that. But for you to be a successful entrepreneur, these are the things that you need to hire people to do. Because this, by being, keeping all those documentation, having the budgets, keeping the cash flow, knowing the business, that's going to, especially if you end up hiring someone to do that, even it can be, like I said, I started part-time. It relieves your mind for you to focus on your company, but it's letting your investors know that you know your company and you understand your company and you recognize that not everything's going to be rosy in the future. There could be problems, and we're going to address it, and we're going to notify you, and we're going to be aware of it, and you're going to be partners with us. So I'm going to go through some of and please, anyone online, but I'm going to quickly go through kind of what the questions that you had. See, if we want to add some more things, but also please, questions, raise your hand, anything. Because again, this is my life per se. I do this all the time. And I recognize that, sometimes when I talk to engineers, and I know you're not all engineers, but I tend to work with a lot of engineers. The glass over happens, like, what are you talking about? So the longer term focus, I think that's what you were asking. So I think what this is trying to show is when you do forecasts and when you're looking at companies, very often, it always still amazes me. They want 3 to 5 years. Let's face it, after a year or two, things get really fuzzy, especially when you're a startup company. But what I think what this will help you to do is it's looking at your market, it's understanding where growth can come. I remember when I talked about before, like maybe it's a $10 billion market and like, oh, I can get 5%. Well, by putting a budget together, by putting that cash flow detail together, you have to outline where the customer's coming from. It's not just 5% of the market. You have to say, where is it coming from? And so I think from a long-term focus, that helps, even if it's 12 to 18 months, when you're early, that's still kind of a longer term focus. Then you can go beyond that. But did I kind of touch on what you were asking about?
Yeah.
Okay.
Yeah.
All right. The non-financial entrepreneur, I think that was the woman who just left. But I think what I've hopefully tried to show you is you don't need an MBA degree to put those spreadsheets together. It's literally cash in, cash out. but it's being organized and understanding and identifying each of those. And so and the reason why I always called that my operational cash flow statement, there is a, as many of you probably, there is a statement of cash flows, which, I mean, look, I'm an MBA, I'm not a CPA. I find the statement of cash flow for me worthless. I mean, it doesn't do anything. But from others, I mean, I get it. It's auditors and others, because that's a balance sheet movement, and I get it. But to me, the operational, I can share that with anybody and they understand it. So when I've shared, and what you have to know is when I created this, it was during this, many of you guys really won't remember this, but that was during the 2008 financial crisis. That's when, because we went into the doghouse. I created that, and our banker made me share that with some of their other customers, because it was just very simple, but it made sense. It was very, very straightforward. Forecasting for profitability, should we continue? Should I, do I sell? Do I whatever? So obviously this is not going to answer that question. However, I will say that the company I'm working at now, we have some different product ideas and different things going on. And so when I modeled out our budget and our cash flow, we were all like, interesting, because it was a lot heavier capital up front. And so the question then is that what we really want to do? Are we that type of company? We're still going through that answering, but by doing that forecast, understanding, because for example, and what this one is, it's a monthly subscription, but there's an upfront capital cost that the customer doesn't pay, you do. So let's say, and this isn't exactly, but many of you may have this, but let's say you're giving them equipment, or you're giving somebody software, you're giving them something, but then they pay over time. Well, for you, from a cash flow, I just had to put out $1,000 and I'm going to get paid, but my return might be 9 months, 18 months. So the question is that viable? So I think by doing this, it helps you to determine, when can I be cash flow positive? When can I turn that profit? And there is a difference between, as we know, there is a difference between profit and cash. Because again, maybe I put that $1,000 up front. So from a profitability standpoint, from a geek accounting, I'm profitable every month because that $1,000 I get to take out over the life of the contract. But cash flow, I'm negative 1,000 and I'm getting $50 or $100 a month. That's going to take me a while. So those are two different things, which is why I have kind of those two different cash flows. So like this thing that I just talked about, that would be the weekly cash flow, not the EBITDA, because the EBITDA is not going to recognize $1,000 kind of investment, because that's going to be a capital. Forecasts for potential buyers are, so I think you had asked about, we're not profitable yet, which most entrepreneurs aren't. But what this is but by you putting out a budget, by you putting out that forecast, then you're able to tell them, because we've all done it. I mean, every company I've worked at, you start off unprofitable. That's the whole point. I mean, maybe that's not the whole point. Sometimes people have maybe done consulting on the side, done something to, to keep cash flow positive. But by doing a forecast, what you're showing the customer or a potential investor is, here's what I'm expecting. And that's all they worry about initially, is they want to see how fast are you able to bring on customers? How fast are you able to turn a profit? And when? That's by doing the budgeting and then doing the forecast. They're not expecting that from day one. And I think the other thing that's also critical when people are looking at ROI and looking at valuation of a company, and this is different, and just so you all know, I've never worked at a venture capital. I've never been in private equity. I've had to deal with them, but I've never been on that side. Gross profit, gross profit, gross profit. It's about gross profit. Because if someone buys you, remember what I said? They're not buying a company because I'm a really good finance person. I mean, maybe they do keep me on. In most cases, they don't. because they're bringing it in their finance group. They're bringing in kind of below. It's about the revenue. It's about getting logos. It's about bringing in new customers. And it's being able to show that that product is profitable. That's the key. You know, the below the line, below gross profit, finance, accounting, maybe even sales, being something that's not unimportant. But for a potential buyer, it's more about the product. And then the long sales cycle. I think you had asked someone that asked. I mean, I think I hopefully explained some of that, because trust me, I've seen it. Every now and then you have a bluebird that someone calls on a Monday and 3 weeks later you have it signed. Those are the exceptions. And I think where it's key when you're doing forecasting is you really you start with being conservative. You be more aggressive on the cash out, you're conservative on cash in, because again, remember I said bankers don't like to be surprised. Neither do investors, neither do owners. So all of a sudden, when you kind of go, yeah, we're gonna run out of cash next month. Okay, what do we do now? Whereas if you say, hey, 6 months from now, we're going to be a little tight on cash. Even that's a little tight. They'd rather you tell them like 12 months out, because then you have time to, to go out to the market or to develop cash. By doing all of this, that's where that's how you provide that information. But the biggest challenge for doing all this is you just have to keep it up. It has to be part of your kind of a weekly and a monthly routine. Again, whether it's you or you bring someone else to do it, but you have to, because so often you will hear people get like, "Ooh, I just got $10 million," and that sounds like a lot of money, and it is a lot of money. But depending on what you do, man, it can be spent pretty darn quickly.
At what point should you be hiring someone for your company?
To do this, excellent question. So what I would probably, especially if you're an early, like a first time entrepreneur, I think where you have great opportunities, there are companies out there where you can hire kind of fractional CFOs or part-time accountants or any. I would 100% start with that. Is I would go to an accounting firm who can again, just bring in someone I'm just making 10 hours a week or something like that, because you don't need to invest big to start. So like the company I'm at now, I started part-time. I was bigger than they needed me, but I also have known the gentleman who owns this, I've known for like 30, 40 years. But I was in time in my life that I'm like, sure, I can help do this. So what I would suggest is, you don't need to do it like day one, but day one, though, you or somebody needs to be still tracking some of this stuff. But I would say, quite frankly, I feel like you'll know when you're like, I can't keep up with this. It's not that it's getting complicated, but maybe you have a couple customers, a couple vendors. I would also suggest when you start having employees, you want to bring in an outside, because I'm telling you, dealing with payroll, I don't do payroll. I don't do a payroll, because payroll taxes are a huge pain in the butt. So what I would suggest is if you start hiring employees and where you have to issue them, like if it's you and your buddy and that's fine. But if you start hiring employees, I would suggest that you start looking at bringing in an accountant. And I would not suggest hiring right off the bat. I would go to like an accounting firm and just bring someone in, on hourly, if they have junior people. And therefore when it comes time for taxes and stuff like that, they have the resources to maybe bring it, have more.
Thank you.
Is there anything else? I mean, hopefully I've gotten something out of this. Hopefully it was worth your time. Anyone online? All right. Well, I thank you all for your time. I appreciate you spending your time with me, and I wish you all good luck with the businesses or the ventures that you're heading into. All right. Thank you.